Thank you for joining us and welcome to Business Incorporated. I'm Chimezie Obi Iwagu. On the program today, Nissan and BMW in talks to pull South Africa into electric car era. And Care's East African Portland Cement withdraws notice dismissing workforce. Plus, Zambia asks Glencore unit to rescind mine shaft closures. Well, let's get the show started now with the markets. And some markets here on the African continent are closed for the Eid al-Kabir holidays, including Nigeria and Egypt. But on Friday, the Nigerian equities market ended the first full week of August negative as the main index declined by 0.43% to close at 27,306.81. In Egypt, blue chip stocks had their strongest day in nearly 6 months on Thursday as better than expected July inflation data and a host of strong corporate earnings buoyed investors ahead of the Muslim holiday. The EGX 30 rose 2.2%, its biggest single-day gain since February, with Commercial International Bank increasing 1.2%. And in South Africa, the market is currently trading with the JSE index up marginally at intraday. The Kenyan bourse closed 0.59% positive on Friday. And the Middle East markets remain shut as well for the Eid al-holiday this week in Saudi Arabia and at least 3 days in other Gulf countries. At the end of last week's session on Thursday, Saudi Arabia's index further gained 0.8% after snapping a 5-day losing streak in the last session. Dubai's index closed 0.2% higher, with Emma Properties gaining 1.9% and Air Arabia climbing 3.5% after the budget airline posted a 75% jump in its second quarter profit. Right, let's look at what the European market is doing. Stocks gave up strong early gains in morning trade, with volatility continuing for global markets as investors monitor escalations in the U.S.-China trade war. Investors also have an eye on political developments in Italy after Deputy Prime Minister Matteo Salvini's League Party filed a no-confidence motion to bring down the government on Friday. Well, my colleague in Frankfurt, Annette Wisbert, will tell us more. Hello, Annette. Good afternoon. Wonderful. Good to see you again.
Yeah, good to see you.
Right. So what's the latest on Italy?
Well, it's an interesting one, Italy, because nobody really knows what's going to happen during the course of August. So over the weekend, we had kind of a momentum that the other parties in Italy actually are sort of perhaps moving a bit closer together against Salvini, because his Lega North clearly wants, or he himself wants to be the sole runner of the country. So he wants to sort of end the coalition which is currently in place in order to make use of the momentum that his party could eventually be the leading party in Italy. So what he wants is to dissolve parliament, to have snap election as soon as perhaps October this year. But what happened over the weekend is also a sign that this is not so easy actually to have, because it's not clear whether he could actually gain a vote of confidence in parliament or lose it. And then B, it's actually not clear whether he could eventually win those elections or whether we are not going to see a caretaker government. So, but one thing is clear, political insecurity is back in Italy. We have seen that with spreads moving higher or wider, I should say, during the second half of last week. But then Fitch came out with a rating reinstallment, so no downgrade, which was a big relief, I guess, for the markets. But for now, bottom line is Italy is still a wild card when it comes to the political development in the country.
All right, Annette, aside from Italy, China-U.S. trade war is also rocking the market there, and then Chinese investors, mergers and acquisition activity slumped in first half of the year as trade tensions increase uncertainties. What does the outlook look like?
Yeah, it's interesting that we're also now seeing a clear slump in M&A activity from Chinese investors during the first half of this year, especially in Germany. The UK is actually holding up pretty strongly still when it comes to the euro area, or Europe, when it comes to Europe, I should say. So Chinese investors are wary about their outlook. Clearly, the economic situation, the domestic economic situation is weighing on their risk appetite to do more M&A activity abroad, because clearly it costs them money, and in case the economy turns south, then they might end up in having a financing problem for all the debt they need to raise to actually be able to do M&A. So what we've seen is more or less a standstill of M&A activity for Germany, but Ernst & Young, the consultancy agency who has conducted that study, is saying that they expect this to be the bottom of the cycle, and once the trade dispute or trade war is going to get resolved, and also economic activity is picking up, then M&A should pick up as well. But for now, we don't really know when we get a resolution of the trade war, and also economic activity doesn't look that great for now, especially in Germany.
And in the UK, British pound dipped to 3-year low against the euro. Why is that?
It's because Brexit might eventually happen at the end of October. Nobody knows whether it will be a hard Brexit or not. The likelihood of a hard Brexit or a crashing out of the UK from Europe has tremendously increased ever since Boris Johnson came to power as the new Prime Minister of the UK, because he was making it pretty clear he's going to lead the country out of the Europe. No matter in which way. So the hard Brexit is actually something which is increasing in its likelihood, and that is clearly also mirrored in the market reaction. The pound is down more than 3% towards the euro since July, and even more than 5% towards the dollar since in the same time horizon. So it is pretty much unclear how Boris Johnson wants to actually negotiate something new with the European Union, because the European Union is also saying they're not going to reopen the deal, and the only possibility to not reopen the deal is to actually crash out of Europe, and that's why we see that current weakness in the pound. With that, back to you.
All right, Annette. Well, it's a holiday here, and I'm sure we have quite a lot to chew in the course of the week. In the meantime, enjoy the rest of the day. And major markets in Asia Pacific closed higher today, following a volatile week for global markets as growing trade war fears dented investor sentiment. Mainland Chinese markets bounced back from the previous week's losses to close higher. The Shanghai Composite traded up 1.45% to close at 2,814.99, while the Shenzhen Composite added 1.92%. Hong Kong's Hang Seng Index was fractionally higher at 25,962 points. Markets in the rest of the region rose, with major indices in Japan, India, and Singapore closing for public holidays. Australia's benchmark ASX 200 retraced some of its early losses to climb marginally higher. In South Korea, the Kospi clawed back losses to rise 0.23%. And in the U.S., stock index futures dropped in the morning, pressured by worries that an ongoing trade dispute between Washington and Beijing could tip the world and U.S. economies into recession. And losses accelerated in early trading after Hong Kong International Airport cancelled all departures for the remainder of the day, citing serious disruptions due to intensifying protests. Around 6 a.m. Eastern Time, Dow futures indicated a negative open of about 120 points. Futures on the S&P and Nasdaq were both lower. Market participants have been monitoring the dollar-yuan exchange rate closely following an escalation in trade tensions between Washington and Beijing. On the data front, the federal budget for July is expected to be published at around 2 p.m. Eastern Time. In corporate news, Cisco and Barry Gold are both expected to publish quarterly earnings before the opening bell. On the precious metal market, gold edged up today, holding above the psychological $1,500 level amid concerns over slowing global economic growth as the trade war between Washington and Beijing drags on. Spot gold was up 0.4% at $1,502 dollar per ounce, while U.S. gold futures were also up 0.4% at $1,514 an ounce. Among other precious metals, silver gained 0.3% to $16.99 per ounce. Platinum was down 0.4% at $855.87, while palladium rose 0.4% to $1,427 an ounce. And global oil market prices fell today amid worries about an economic slowdown and the U.S.-China trade war, which have led to a cut in the outlook for global oil demand. Our international benchmark Brent crude futures were at $58.16 a barrel, down 37 cents from their previous settlement. U.S. West Texas Intermediate futures were at $53.89 per barrel, down 61 cents from their last close. Both benchmarks fell last week, with Brent losing more than 5% and WTI falling about 2%. Although the third quarter is fundamentally the strongest season for oil demand because of driving in summer holidays, the trade dispute between the United States and China has weakened demand and reduced crude prices. And Saudi Aramco, the world's top oil producer, has released its half-year earnings, showing the company's net income at $46.9 billion, down from $53.02 billion a year earlier. Aramco says that total revenues, including other income related to sales, were at $163.88 billion in the first half of this year, down from $167.68 billion a year earlier on lower oil prices and reduced production. The report also shows that earnings before interest and taxes came in at $92.5 billion for the period, compared to $101.3 billion for the first half of 2018. The company increased its dividend payments from $32 billion at the halfway point of last year to $46.4 billion, supported by a $20 billion special dividend paid earlier this year as a result of its exceptionally strong financial performance in 2018. And in the meantime, the Nigerian National Petroleum Corporation plans to partner with Dangote Refinery under construction on the shores of Lagos to turn the oil-producing country into a fuel supplier for the region. The aim to ink a contract with the Dangote Refinery with a capacity of 650,000 barrels per day is part of the new Managing Director Mele Kyari's blueprint for transforming the corporation into a world-class state oil company.
In his first interview with an international media since taking office last month, Mr. Kyari said he would publish the full list of those holding the nation's crude oil contract and the firms who won deals to swap Nigeria's crude oil for products, along with audited accounts of NNPC's books. He said the openness and the plan to improve commercial terms for oil companies would spur investment that has been throttled by uncertainty and opacity.
I think what we need to do is the most important thing we need to do is to improve on the legislative framework. Yeah, that's very critical for every investor. And beyond that, you do need to focus on some form of accountability and transparency that our partners are looking forward to. The world is looking forward to that. And there's this perception that Nigeria is not is a very opaque business environment, and we're going to do everything possible to make that open. Business is open so that people can actually predict what we're going to do next, and I believe that that will going to help.
NNPC is also pressing ahead with plans to revamp its own ailing refineries, despite a nameplate capacity at Dangote Refinery that is well above Nigeria's consumption. While Kyari said they are considering both government and private funding, after the revamps, third parties will maintain and operate the state-owned refineries to ensure reliable production.
There are a number of investment decisions that cannot be made now because investors are wary of the fiscal environment. And once we sort out the fiscal issues and the commercial issues around those transactions, I believe that we can easily go back to investment and then grow the production and the reserve to that level that we're looking at.
NNPC is in talks with all operating partners to improve commercial terms, but he said the long-delayed legislation to overhaul the oil sector, known as the Petroleum Industries Bill, needed to pass quickly to spur investment.
When we produce, there's a market for it, either here within the West African sub-region or beyond it, and the product market is there, so we know this. So we do this, we can now satisfy local needs and also possibly export products.
The mammoth bill covering everything from fiscal terms to Niger Delta community engagement has been in the works for over a decade. But Kerry said the current government with the legislature controlled by the party of President Muhammadu Buhari could pass it.
I think what we need to...
Meanwhile, Dangote Refinery won't be finished until the end of 2020. Details in a moment. To stay with us.